Chapter 3, Financial Analysis. Chapter 3 Outline. What is financial analysis? 4 categories of financial ratios. Techniques of ratio analysis. Distortion in financial reporting, summary, and conclusions. Learning objectives. Calculate. Calculate 13 financial ratios that measure profitability, asset utilization, liquidity, and debt utilization. Assess. Assess a company's source of profitability using the DuPont system of analysis. Examine. Examine the ratios in comparison to industry averages. Learning objectives. Examine. Examine the ratios and company performance by means of trend analysis. Interpret. Interpret ratios and identify corrective action for abnormal results. Identify. Identify sources of distortion in reported income. What is financial analysis? Evaluating a firm's financial performance, calculating ratios to reveal relationships between different accounts of financial statements, linking ratios to reveal the factors determining a firm's profitability and value. Financial analysis may not answer questions, but leads to further inquiry. Classification system of financial ratios. A. Profitability ratios. B. Asset utilization ratios. C. Liquidity ratios. D. Debt utilization ratios. A. Profitability ratios. Show how profitable a company is. 1A is profit margin. 1B is gross profit margin. Number 2 is return on assets, which is ROA, or investments, which is ROI. 3, return on equity, ROE, for common shareholders. B, asset utilization ratios. Show how effectively a company uses its assets. 4A is receivable turnover. Formula 4B is average collection period, days sales outstanding. 5A is inventory turnover. 5B is inventory holding period. 6A is accounts payable turnover. 6B is accounts payable period. 7 is capital asset turnover. And 8 is total asset turnover. C, liquidity ratios. Show how liquid a company is or how much cash it has available to meet short-term needs. Formula 9 is the current ratio, and Formula 10 is the quick ratio or the acid test ratio. D, debt utilization ratios. Show how well a company is managing or using debt. Formula 11 is debt to total assets. Number 12 is times interest earned, and number 13 is fixed charge coverage. Table 3-1, non-IFRS financial statements for ratio analysis of private companies. So we have the income statement for Saxton Company. You have its sales minus cost of goods sold to equal gross profit, minus selling and administrative expenses, which also includes a $50,000 lease payment, which is fixed, to give you operating profit, or earnings before interest and taxes, minus interest expense and an extraordinary loss to get net income before taxes, which is also earnings before taxes, minus your taxes to get net income, which is also earnings after tax. Table 3-1, non-IFRS financial statements for ratio analysis of private companies, Part 2. So we have Saxton Company balance sheet as at December 31st, and this is in liquidity order, so it has your current assets, then your long-term assets for your total assets, then your current liabilities and your long-term liabilities for your total liabilities, then your shareholders' equity for your total liabilities and shareholders' equity. Profitability ratios, Part 1. The profit margin formula is net income divided by sales, and Saxton Company is 5%. So the net income and the sales come from the income statement. The gross profit margin is gross profit divided by sales. So for Saxton Company, the gross profit and sales come from the income statement, and that's 25%. Return on assets is net income divided by total assets. So for Saxton Company, the net income comes from the income statement and the total assets come from the balance sheet for a total of 12.5%. And then return on assets, which is ROA, is basically you can just take your net income and divide that by the total assets. So the net income comes from the income statement and the total assets come from the balance sheet, and you get 12.5%, and then you can compare them to the industry average. Profitability ratios part 2. Return on equity is the net income divided by shareholders' equity. So with Saxton, it's 20% comes from the income statement, which is net income, and the total shareholders' equity, which is from the balance sheet. The equity multiplier is just the total assets divided by the shareholders' equity. And so for Saxton, it's 1.6 times, and both those amounts come from the balance sheet. The return on equity, so it's the same formula as 3-3A, except for you can just take your return on assets and multiply that by the equity multiplier to give you 20%, and that will give you ROE 20%. DuPont analysis reveals the relationships between profitability ratios and asset utilization ratios and debt utilization ratios. Decomposes return on asset, ROA, into two factors. ROA equals net income divided by assets. So you can take your profit margin percentage, which is the net income divided by sales, and multiply that by the asset turnover, which is your sales divided by assets, and that will give you your ROA. DuPont analysis part 2 decomposes return on equity into three factors. So return on equity is just your net income divided by your equity. So if we look at the formula, the profit margin is net income divided by sales. The asset turnover is sales divided by assets, and the equity multiplier is assets divided by equity. So return on assets equals return on equity equals return on assets times by equity multiplier. And you can see in this three parts to this formula, sales is on the top and bottom, so that cancels itself out. And assets is on the top and bottom, so that cancels itself out. And so that's why we're only left with net income on the top and equity on the bottom. Figure 3-1 DuPont analysis. Net income divided by sales divided by total assets, profit margin times asset turnover to give you return on assets, total assets divided by equity gives you the financing plan equity multiplier, which equals return on equity. So it's just another way of looking at what we just covered in the previous slide. Question 1. How has the ROE changed for each firm from results of late 2019 and table below to the current year as revealed by DuPont analysis? Asset utilization ratios, receivables. The receivable turnover is your sales, which are on credit, divided by your accounts receivable. And for Saxton Company, it's the $4 million from the income statement divided by the accounts receivable from the balance sheet. So that gives you 11.4 times. And sometimes we'll only see the net sales on an income statement. So usually we'll just use that number instead of the credit sales. The average collection period is the accounts receivable divided by the average daily credit sales. So that's $350,000 from the balance sheet and $10,959. So you can just take that $4 million and divide that by 365 to get that in days. And then that gives you 32 days. Asset utilization ratios, inventory. So the inventory turnover is cost of goods sold from the income statement divided by inventory. So that gives us 8.1 times for Saxton. The inventory holding period is inventory divided by average daily cost of goods sold. So that's the 370,000 from the balance sheet, and then you can get the average daily cost of goods sold by just taking that 3 million and dividing it by 365 days. And then that will give you 45 days. The asset utilization ratios payables, we have our accounts payable turnover. So we have cost of goods sold divided by accounts payable. So the 3 million of cost of goods sold comes from the income statement, and the 50,000 comes from the accounts payable on the balance sheet for 60 times. And accounts payable period is accounts payable divided by average daily purchases. So for most companies, we don't have access to the actual purchases, so we'll just use the cost of goods sold instead. So it's just that 3 million divided by 365 days, and that gives us 6 days. Asset utilization ratios. Assets, for our capital asset turnover, we have sales from the income statement divided by capital assets. Some statements call this fixed assets. So the 4 million is from the income statement and the 800,000 is from the balance sheet. So that gives us 5 times. And the total asset turnover is sales divided by total assets. So the sales of 4 million is from the income statement and the 1.6 million is from the balance sheet. So that gives us 2.5 times for Saxton. Liquidity ratios. So we have our current ratio, which is current assets divided by current liabilities. Both those are from the balance sheet. So we have 2.67 to 1. And the quick ratio is your current assets and then subtracting out inventory. And usually if we're looking at a balance sheet, anything that is current and also below inventory is also subtracted out. But for this reason, it's just easy just to take out the inventory. So those are both from the balance sheet, and then the current liabilities is also from the balance sheet. Debt utilization ratios. So we have the debt to total assets. So total debt is actually your total liabilities from the balance sheet. Divide that by total assets to give us 37.5%. Times interest earned is your income before interest and taxes from the income statement. Divide that by net interest expense on the income statement. So that gives us 11 times. And fixed charge coverage is income before fixed charges and taxes. So I would probably take our income before taxes and then add back any items that are fixed. So that'll give us 600, and that's from the income statement, and then divide that by the fixed charge. So that gives us 100,000. And that's 6 times for Saxton. So the table 3-2 ratio analysis lists all of those ratios that we just went through, the answers to those ratios for Saxton Company, the industry average as a comparison. So if we're just going to compare it to the industry average, then we can just say profit margin and gross margin are below the average. The return on assets is higher. The return on equity is higher. The receivables turnover is higher. The average collection period is a little bit lower, but it's still good. That's saying it takes you roughly 32 days to collect on an account. The inventory turnover is higher. The inventory holding period is a little bit lower, so that just says that it takes us 45 days instead of 52 days in order to turn over our inventory. So that actually is good. We want it to be quicker. So accounts payable turnover is 60, and the turnover for the industry average is 12. So that is really below average. Capital asset turnover is 5 compared to 5.4, so that's below average. And then total asset turnover is 2.5 to 1.5, so that's good. Our liquidity ratios are both above average, so that's good. And our debt to utilization ratios, debt to total assets is slightly above the industry average, but it's still okay. Times interest earned is above average, and the fixed charge coverage is above average, so those are both good. Interpretation of ratios by trend analysis. Comparing a company's ratios to the industry average or industry leader may not be appropriate. Over the course of the business cycle, because of sales and profit fluctuations, yearly ratio analysis may not present an accurate picture. Comparing the same company's ratios on a year-to-year basis is trend analysis and may reveal whether ratios are improving or worsening over the length of a longer time cycle. So we have trend analysis graphs for both the industry and Saxton over a 5-year period instead of just a 1-year period. So we have our profit margin and our total asset turnover as examples. Trend analysis of competitors. So in this case, we're looking at Bank of Montreal and Royal Bank at both their return on assets and their return on equity over the 7-year period from 2006 to 2019. Distortion in financial reporting. Historical-based accounting in an environment of changing prices may distort financial results. Immediate effect of price changes, inflation and disinflation, on revenues versus delayed impact on asset values. Accrual-based accounting allows certain leeway in matching the revenues and expenses. Costs of goods sold, LIFO versus FIFO. In Canada, we're not actually allowed to use LIFO. Asset write-downs and net income. Table 3-7, income statement. Income statement for the year 2000 XY. We have a conservative A and a high reported income B. So you can see the difference at your net income at the very end. So our earnings after tax and extraordinary loss, that's transferred into the retained earnings. So 240 and 780. Summary and conclusions. Financial ratios cover 4 areas of management: profitability, asset utilization, liquidity, and debt utilization. The DuPont system of analysis tells us that the profit margin, asset turnover, and debt usage each contributes to the return on equity. Ratios should be compared to industry average, comparative analysis, as well as historical data, trend analysis. Summary and conclusions, part 2. What ratios do is to suggest aspects requiring further exploration. It is the manager or the analyst's job to answer the questions revealed by ratios. Analysts should also be aware of the distortion in financial reporting.